Tēnā koutou katoa. My name's Kath Lomax and I'm the Chief Client Officer here at Fisher Funds. So welcome to our virtual dynamic roadshow about the smart investor. So we're welcoming you today in a very different environment than we have been in the past, and it's all about being dynamic. So not only is our roadshow dynamic, also we're really going to be hearing from the team about what's been happening around the companies around the world, how have they been adapting and changing, what we've been doing within your portfolios, and also how we've been helping you and our clients with their strategies to succeed. So a very warm welcome. I know many of you, like myself, loved meeting last year in our roadshows and having a drink and a chat, and we all loved Frank's broccoli and chicken story. So don't worry, we're going to find out from him at the end what's on the menu for dinner at the moment. But in the meantime, we've done things a little bit differently this time. Also, we plan to come out to you early in the new year, so we really look forward to seeing you in person then. So a couple of things before we get started that I did want to mention was, firstly, this is information only, so it's not financial advice, so it doesn't take into account your own financial situation. However, we do have a great team of advisors, which I'm sure many of you know, and they will be able to answer any questions and will be happy to pick up the phone or chat to you via email at any time. So before I hand over to Frank and the team, I just want to say how proud we are of the Fisher Funds team here. So the investment team have done a phenomenal job in what has been incredible market conditions, and they are returning phenomenal returns to our clients, which are market leading. As well, our advice team has been as busy as ever answering your emails and phone calls to make sure that your strategy that you've got in place is the right one for you. So we're really proud of the team, and for me that's really about our smart active investment, the experience of the team. Both the advice team and the investment team have gone through a lot of market volatility in the past, and so they know how to manage your money really well, and the experience that we've got. So I'm going to hand over to you, Frank, and enjoy.
Thanks, Kath. It's been a remarkable time for all of us to be alive. We've lived through a major global pandemic, and that pandemic is having significant effects on global healthcare, on the global economy, on businesses and on markets. What we've all learned to do is we've learned to adapt. We've learned to adapt to a new way of living, we've learned to adapt to a new work environment, and businesses have had to adapt to the different business environment that they're experiencing. The best businesses in the world have adapted to that in a very dynamic way, pivoting very quickly to this new environment that we're in. And that's what we really want to explore today through three different lenses, how the best businesses in the world have adapted dynamically to the environment we're in, what we've done in our portfolios to adapt to this new environment, and last but not least, for you, our clients, what might you need to do differently to be best positioned for the post-COVID world that we're in. We want to do that today with a panel of great Fisher Funds experts. To my right, David McLeish, who's Head of Fixed Income, Sam Dickey, who runs our New Zealand equity portfolios, Vicky Watsons, who's one of our senior client advisors, Robbie Urquhart, who runs our Australian equity portfolio, and last but no means least, Ash Gardine, who runs our international equity portfolios, and has just run 75Ks, so he's very glad to be sitting in a chair, so a very, very happy man. So I want to start off by talking about the business environment that we're in, what trends we're seeing, and how businesses are adapting to those newfound trends. So Robbie, I thought we'd kick off from you by really talking about those trends that have surprised us in this post-COVID world.
Yeah, well, thanks, Frank. You know, one trend that has surprised us has just been how strong demand for housing has been through the midst of the pandemic. I mean, I guess with interest rates and mortgage rates getting cheaper, it stands to reason that housing affordability has improved. But nevertheless, with the amount of uncertainty out there, the demand for housing has certainly surprised on the upside. You know, we were on a call with the REA Group CEO, Owen Wilson, a few months ago. And REA Group is the online real estate advertising platform in Australia. And he was saying just how they had 109 million visits to their website in the month of May alone. It was an all-time monthly record for them, and that was soon to be surpassed a couple of months later with 114 million visits. So, you know, the demand has been really strong, and it's lasted through the course of the last few months. We've seen that in New Zealand as well. Here at Fisher Funds, you know, our first home buyer withdrawal numbers have bounced back to all-time highs as well. So that's been one thing, demand for housing super strong. A second trend that's also surprised, you know, this time sticking with Australia, has been the demand for cars and accessories for vehicles. It seems that with travel restricted, people aren't flying anywhere, so in Australia, that means they're buying cars and souping up their 4x4s and heading to the outback. And we saw our ARB Corporation, which is one of our companies in Australia, benefit from this. So talking to the chairman, Roger Brown of ARB Corp, which sells 4x4 accessories, the management team there was just incredulous with how quickly they saw the conditions change. So they went from April, where demand fell off a cliff and they were looking at shuttering production capacity, to May, where they had to go into production overdrive and work overtime to make up orders that had just soared. And they ended up with June and July being consecutive monthly record of sales of the likes of bull bars and roof racks and bike racks and so on. So it's a very dynamic environment and companies are having to adapt.
It's remarkable how things just don't play out as you'd expect. The number of articles that were written during March and April that the housing market was history, everything was going to be down 10-15%, and yet the exact opposites happened. Quite strange. Ash, obviously some of the trends that we've seen have been a little more predictable. What are the things that have played out a bit more to script along the way?
Yeah, absolutely. So Robbie pointed out some of the things that were a bit surprising, but there were also lots of things that perhaps weren't as surprising once you realised that the pandemic was going to be global and there were going to be lockdowns all across the globe. So things like working from home, we all had to find a new way of working from home, which led to things like Zoom webinars, which we're doing now. So a new technology we're all having to embrace, and we've had to buy headsets. So that's one thing. The other thing would be cloud adoption. People have had to figure out a way of working from home. So corporates have been using either new cloud software solutions or just starting to move their workloads to the clouds to help their staff that are working from home. Another interesting trend has been sort of the death of cash. A lot of corporates have been trying to move away from accepting physical cash in stores because the reality is it's not the most hygienic solution. Instead, they're using things like PayWave and PayPass. And a great example would be MasterCard, which is one of our portfolio companies that has seen a 200% increase in PayWave usage in India since COVID started. So there are lots of trends like that. Perhaps another one would be Amazon. We've seen a real rapid growth in the rise of e-commerce. And we'll bring a chart up on screen now which just shows the penetration of online commerce went from about 6% 10 years ago to 16% at the start of the year. So a 10% increase in 10 years. It jumped another 10 or 11% in just 10 weeks. So the acceleration really has been phenomenal. So there are certain businesses that have benefited from these trends. But the most interesting thing actually has been how companies have adapted to these challenges. And the ways that companies have adapted to these challenges really have decided who the winners and losers have been. And just to use the Amazon example, it's an interesting one because it's a slightly controversial company sometimes, but they really have adapted in quite an interesting way. They hired 150,000 new workers, which they pay extremely well, and they had overtime bonuses and extra pay for staff, and that allowed them to meet delivery timetables that were really quite tight. And they also pivoted away from delivering things like televisions and discretionary items towards healthcare, food, hygiene equipment. So all of those things hurt their short-term profits, but they've resulted in many, many new customers joining the platform, and that should stand them in good stead for the future.
It's remarkable, isn't it? Words like 150,000 new employees, they trip off the tongue very quickly, but when you think about what that actually means to do, that's an incredibly difficult thing to do. Sam, I was interested in taking that idea of Ash's a little bit further. So if we look at the companies that have done very well and managed those kind of challenges and those pivots successfully, are there common threads in those companies that I think we can all understand and get a sense of what the best companies going forward might look like?
I think it was initially just the luck of the draw. So if you were unlucky enough to be in the tourism and travel industries, it's been very tough and continues to be very tough. And if you were lucky enough to perhaps to be in the healthcare industry, you've had a much better road through this crisis so far. But that's quickly changed, and we've seen 2 or 3 themes or threads emerging from our most dynamic companies. The first one is really doubling down on that customer obsession. So if we take Ryman and Somerset, for example, this could have been a very, very tough time for, most importantly, their vulnerable residents, but also for Ryman and Somerset sales at the back of this, if it had been managed badly. But it hasn't. And what we've seen very early on was Ryman and Somerset move to protect those vulnerable residents. So, for example, way back in January, they'd restricted visitation rights before a lot of us had even heard about the coronavirus. Secondly, take Somerset. They've got 7,000 people on their prospective customer list. They contacted every single one of those people, not to sell Somerset product during the crisis, but to make sure those vulnerable people were safe in their houses, and if they needed groceries delivered, that Somerset could help out. And if we take Ryman, they pride themselves, or their residents love their happy hour. And I was actually just at Jane Winstone in Wanganui yesterday to see my 98-year-old grandmother. And I thought they had a happy hour every night, but she reminded me it's just Friday night, so that's good news. Thanks for that, Zita. But during the lockdown, obviously, given social distancing restrictions, they couldn't have these happy hours, which the residents love. So Ryman came up with the innovative way of getting around that, which was happy hour in a bag. Which means you get delivered your drink of choice on a Friday night and you have a Zoom call with your
Definitely need to adopt that one at
with your
Fisher
friends.
Funds.
Yeah. Happy hour in a bag. So that was a good one. What does all of this mean? As you can see from the slide there, that's Somerset sales, and they just released their Q3 sales the other day, and sales are growing at the fastest rate in 5 years because they looked after their customers, and their customers are now doubling down on looking after Somerset and Ryman. So that's the first company that comes to mind. The second one is Mainfreight. We all know, they are obsessed with their people and their customers. And during the lockdown, during the crisis, they had a mantra of not losing any permanent people, firstly. And secondly, they paid discretionary bonuses in line with last year, which is quite rare in this environment. What does that mean? That means their people looked after their customers more than ever before. And finally, what does that mean? That means that Mainfreight's taken $70 million worth of market share off its less prepared competitors, which is the fastest cadence ever for market share gains for Mainfreight. So that was the first thing. The second one is that we're seeing some of our most dynamic companies have confidence to invest ahead of the curve on some of these trends that Robbie and Ash talked about. So take Serco as a pretty simple example. Their volumes and revenues are still down 60 to 70% versus pre-COVID levels. But Serco's share price is at all-time highs. So why is that? That's because the travel industry is potentially changing forever. So what I mean by that is Serco's key customers are travel management companies or travel agents. And sadly, they're not hiring back as many agents as they had on previously, and they're increasingly turning to technology to support them here. And we think Serco's got the best online booking technology globally. Not voted by us or by Serco, but voted by Booking.com or Booking Holdings, which is a $100 billion company who've twice invested in Serco's equity. So Serco raised equity just a few weeks ago to invest ahead of these trends that we're talking about. So what does all of this mean? This means that, as Anna Curzon said, this is a real burn the ships moment. And by that she means we're never fully going to go back. Those trends that Robbie and Ash talked about, they're never going to fully reverse. And we think that most dynamic companies in the world see this, and so should we.
So the COVID pandemic has created new trends in economies, for business, and for all of us as consumers. And what we've really seen is that some companies have been able to use that to their advantage and other companies haven't. There definitely have been winners or losers in markets. The best management teams have adapted really dynamically to those new trends, have been obsessed with giving great customer service and really keeping their customers very close to them during this time. But they've also been prepared to invest ahead of the curve to build their business for the post-COVID world that we know is coming. Just as the best companies in the world have had to adapt really dynamically to this new environment, so too have we as investors. All of you on the call will remember that we went through a tumultuous drop into March the 25th. In fact, it was the fastest 10, 20 and 30% sell-off in share markets that we'd ever experienced. And subsequent to that, we've had this very rapid bull market, very kind of head-snapping time to be an investor. I want to explore now what we've been doing within our portfolios to adapt to this dynamic new environment that we're in. And I wanted to start off by talking to you, Ash, about what we experienced through that first month, the big sell-off in markets, and what lessons are there for all of us as investors through that experience.
Yeah, so you painted the picture really well, Frank, and February, March was certainly a really wild time in markets, and the drop was very rapid, it was drastic, and it had a lot of people nervous and unsettled. So I manage our international share portfolio at Fisher Funds, which means we invest in global businesses like Amazon and Google, and we try and hold these businesses for the long term. But in an environment like this, you do get some unprecedented opportunities, and they come up pretty quickly. So what do we learn from this? Well, I guess there were two things, but the first thing was that you have to be prepared ahead of time. You don't want to try and buy an umbrella when it's already raining, and thankfully our investment process really does help us here by investing in high quality businesses, companies with high market share that are leaders in their fields, highly profitable businesses, ones that don't have too much debt or aren't very cyclical. We were really well positioned ahead of time. So when markets fell pretty drastically back in February and March, we held up better than the market, and we could quickly pivot and invest in new businesses that we thought would do particularly well during the rebound. The second thing that we learned is it really pays to have a large investment team, and we have the largest New Zealand-based investment team here at Fisher Funds. And having a long list of investment ideas ready to go so that when a crisis hits you can move really quickly, that certainly helped us. And in fact, during that period we managed to add 6 new companies extremely quickly. 2 of them were Hilton and Starbucks, so names that everyone will know. And that was only possible because effectively we were already ahead of time. So I guess the points are you need to have a plan, and that's not just for investors like us, but this is for individual investors as well. And then secondly, you need to be ready and feel free to have a swing if there are some good opportunities.
The way you've described that reminds me very much of that Mike Tyson quote, actually. It just jumped to mind about, we've all got a plan until someone throws a punch. But Dave, how did you deal with that Mike Tyson moment? So within your fixed income portfolios, how were you positioned going in? What opportunities were you seeing? What are your experiences of that really tumultuous time in markets in the fixed income world?
Yeah, thanks, Frank. The insights that we gather about the global economy have been extremely valuable to us over the past year. Even before the enormity of the coronavirus was apparent to us, our indicators were suggesting that there was a heightened risk of a global slowdown ahead. What you'll see on this diagram here is when we put this together in December 2019, you'll see a lot of the global economies were already transitioning from the expansionary phase of the economic cycle into a downturn. So what did this mean for our conservative strategies? Well, this meant that we were already holding more of the most highly rated government bonds in our portfolios and less of the more economically vulnerable assets like corporate bonds when the crisis hit. Now, as the crisis began to unfold, our government bonds, or those safe haven assets, became very sought after. As the value of those started to appreciate, that gave us the opportunity to sell those down and use those funds to invest in the corporate bond market, which were offering much more attractive yields and some very, very good companies. So fast forward to today, and where are we? Well, as this diagram shows, we've really transitioned now from the repair phase of the economic cycle and are now actually entering the recovery phase. And while corporate bonds have already staged a really impressive recovery from their March lows, we actually still believe that the economic environment, as it improves, will continue to benefit these assets most.
Great. I definitely want to explore what some of those opportunities look like. But before we do that, I'm really interested to take ourselves back in time to March, and it was a scary time. Markets were falling, businesses were trying to figure out this new world. Sam, can you talk to me about what we did just to understand, would our companies survive that, how well were they positioned, and get our heads around what the heck was actually going on, because it was a scary time.
Yeah, it was certainly pretty hectic, Frank. I've never seen the 21 strong investment team work so hard since at least since the GFC anyway, but that's what we love, that's what we've trained for. So what we did is we made hundreds of calls to our companies, their customers and their competitors. And when you've got that volume of information coming in the door, you need to look at every call through the same lens. So we asked each of those calls, or those companies, 4 questions. The first one was, importantly, how are you looking after your people during this crisis? And as Craig Hudson, the MD of Xero New Zealand, said, the best leaders are empathetic, but especially in a crisis. The second thing we asked these guys was, how are you making sure that you're going to survive this? In other words, how's your liquidity and balance sheet position? Third question was, what's the likely outcome for your revenue and profits during this crisis, but equally out the other side? And fourthly, and this is really important for long-term investors like Fisher Funds, is how are you going to ensure that you come out the other side of this as a better and stronger company? So we took all of that information, and as you can see from the slide on the screen there, we quickly bucketed our portfolios into risk levels. So the first bucket you can see on the screen there were beneficiaries. So companies in the healthcare space or companies in the business of selling data. The second bucket was defensives, or companies that have long runways for growth, almost irrespective of the economic backdrop. So that's companies like Xero, for example, or some of our more defensive companies like our US water companies. The third bucket was companies that are more sensitive to the economic cycle, like Dave said, not just the economic down cycle, but also the pretty rapid economic snapback we've seen as well. So that's companies like our US rail companies and Mainfreight, for example. And the fourth bucket was that one I referred to a wee while ago, was companies in the eye of the storm. So some of our airports, for example, Vista, for example, all of their customers globally have been shut. So what this allowed us to do, this quick bucketing of risk, the whole team working at speed, was we were able to own more of buckets 1 and 2, so the beneficiaries and the defensive companies into the teeth of the crisis. And then we switched gears in late March to own more of buckets 3 and 4 to take advantage, as Ash and Robbie said, to some of these once in 5 year opportunities. For example, we bought a lot of Auckland Airport at $4.66 in its capital raising. So in summary, to work at pace in a crisis, you've got to have the team to do it, and the team was on fire. Secondly, you look at everything through the same lens. That allows you to quickly bucket your risk, and then you can pivot in this unprecedented volatility.
Thanks, Sam. So that idea of dynamism that we look for in our best companies, exactly the same thing when you're running a portfolio, that you need to be able to dynamically move between different market states and take advantage of those. That's the most fun part, actually, in some ways, of this strange environment, is that you do get the opportunity, like a kid in a candy store, to buy some of the best companies and best investments in the world at really attractive prices. And I want to explore how we took advantage of that now. So maybe start off with you, Dave, to talk about what you were seeing in the fixed income world, where the opportunities were, and where we could act and make money for our clients.
Yeah, sure. As is often the case in an economic downturn, the bonds issued by banks were some of the worst hit fixed income assets in that period between February and April. Now, why is that the case? Well, that's largely because banks themselves, their earnings are largely tied to the economic environment. And so at the time when the economy was slowing down so quickly, it was no wonder that even some of the largest banks in the world were starting to see the value of their bonds fall quite meaningfully at the time. Now, one of the big benefits of having a large and globally experienced investment team is that we get to devote a lot of time to analysing these types of investments as a normal course of business. And Lyle McNee, one of our investment analysts, heads up our research in this particular area. And it was really thanks to his detailed knowledge of these banks that we were able to react very, very quickly to the opportunities as they presented themselves. Now, what did we do? You'll see actually on screen is that we made 6 investments between March and April of this year in 6 global banking champions. You'll see their names there, and next to them you'll see the returns that those investments have generated since we made those purchases about 6 months ago. You might think that certainly a lot of people will see those numbers and be quite surprised that fixed income assets have generated those sorts of returns. But it just shows that investing in at the teeth of a crisis can actually generate some very, very valuable investment opportunities, even in conservative assets like bonds.
Well, good work, Lyle, and good work, Dave. Hey, on the equity side of things, Ash, you mentioned that you'd added 6 new companies to your portfolios over that period of the intense market stress. Do you want to give us a bit of a flavour of the sort of things you were looking at through that time?
Yeah, absolutely. So those that are familiar with our investment approach know that we're simply trying to own a handful of great companies for the long term, whether that's 5 years or 10 years. Or in the case of the New Zealand Growth Fund, which Sam manages, we've owned some companies like Ryman Healthcare or Mainfreight for 21 years. But then occasionally, in the depth of a crisis every 5 or 10 years, you get a really good opportunity to buy some of your favourite companies at great prices, and you do need to pivot at that point and take advantage. Now, in the International Growth Fund that I manage, we've added 6 new companies to the portfolio this year. We were doing a huge amount of work during February and March, and Chris and Harry, to their credit, did a lot of that from home, and we were able to add as many new companies to the portfolio in 2 months as we usually would in 2 years. And there were companies, like I mentioned earlier, like Starbucks and Hilton, but also smaller companies that you might not have heard of, like StoneCo, which is a payments company, an IT company called Gartner, or a company called Floor & Decor, which I'll talk about in a bit more detail. Now, Floor & Decor is really interesting because it's a US specialty hard flooring company, and we'll put a picture up on the slide here of one of their stores. And what you'll realise from looking at the picture is they've got extremely large stores. They're effectively the size of a Bunnings, but all they do is sell hard flooring products. Now, you would have thought perhaps in a crisis that people would stop thinking about remodelling their homes, but actually in COVID, it was the complete opposite. People had more time at home, they had less money that they were spending on overseas holidays and vacations, so they had time and money to think about remodelling their home. But despite that, in the initial sell-off, people weren't thinking like that, and its share price fell pretty dramatically and gave us a good opportunity to buy Floor & Decor. Now, the thing we like about them is that huge scale and those big warehouses that you can see there effectively allow them to buy product more cheaply, directly from offshore, and sell product at a price that's significantly cheaper than their small competitors, who are usually independent players with 1 or 2 stores. And despite the fact that it's a flooring company, which some of my colleagues will say is a little bit boring, they're growing at 20% per annum, and we think they'll take their store count from 120 this year to about 400 in a decade's time. So we think there's heaps of growth ahead.
And the share price is up 100%, isn't it, Ash,
That's right.
since you bought it? So it's nothing boring about that return.
Nice layup there, Robbie.
Would it be fair to say, Ash, that we've been floored by how quickly that stock price has recovered? Moving on. As I mentioned, it was a remarkably quick sell-off and what's been a remarkably quick recovery in markets since the depths of the crisis. Robbie, where we're sitting right now, what do you think the investment world looks like looking forward from here? So what's our perspective on what things will look like for the next couple of years?
Well, Frank, in a nutshell, there are great investment opportunities out there, but as you sketch out the landscape, it certainly is a more complex environment in which to make those investments. If we look over the course of the last 6 months, the economic environment has become volatile. Companies, as you've heard today, have had to adapt quite dramatically to it. You mentioned the stock market crash in March, very sharp rebound subsequently. We've got interest rates and term deposit rates that have continued to track lower and unbelievably are even lower than they were this time last year. And that's pushing money into all sorts of assets, from Auckland houses to stocks and bonds, which is elevating their prices. So we don't see the abundance of investment opportunities at fire sale prices that we had back in March and April that Dave and Ash took advantage of. But there is scope to add value through active management. And in this environment where the return profile for markets is likely to be a bit lower, we think the value added component from active management can make a huge difference to overall returns. And we see a lot of scope to do that. Sam mentioned earlier how some of the best companies that we're invested in are doubling down on customer obsession, companies like Mainfreight and so on, and companies that are investing ahead of the curve, a bit like Serco. So the businesses that we're invested in are going out of their way to increase the gap between them and the competition, to take advantage of the opportunity set that this volatility provides them. Ash touched on some of these structural trends that we're seeing, the acceleration towards e-commerce, the move to the cloud that businesses are undertaking as this digital economy races towards us. And these are structural trends that are going to last for a long period of time. And we've got a number of companies in our portfolios that benefit from that. So if we think of companies like Xero or WiseTech in Australia, NextDC, Somerset, Amazon, they're all companies that have these characteristics. And we see scope for them to add value and generate returns for investors for many years to come from here. So we're excited about the future. Investing it's very easy. But we do have, as the guys have mentioned, a 21-team strong investment team. And we're out there every day turning over rocks and looking for the next Floor & Decor or the next piece of bank debt that Lau found for us to buy. And our umbrellas are out. So, the next time a financial storm washes through, we are prepared. And we'll jump on opportunities as they present themselves then. So we're excited about the future.
So it has been a remarkable period in financial markets. Not only, as we discussed, has this affected the economy and business, and it's really led to some businesses being winners and losers, but it's meant from a portfolio management point of view that you have to be very dynamic as well, to search very carefully for those companies that, I guess, like Darwin, the survival of the fittest, those companies that can adjust and adapt very quickly to a new environment are the ones that will be successful. So dynamism is absolutely the key from a company point of view and from a portfolio management point of view. We think it extends one step further, and it extends to how we all manage our portfolios as we build our wealth towards our retirement, towards whatever it is we're saving for. And I want to explore in the last section of the discussion what that means for all of us as individual investors. So I first wanted to explore with you, Ash, what parallels you're seeing with how we managed our portfolios through this crisis and what that might mean for individuals building and managing their wealth as they move towards retirement or other financial goals.
So there are actually quite a lot of parallels between what we've been doing in our portfolios and what our clients need to do with their portfolios. As Robbie mentioned, we've actually had to be more dynamic and more flexible in response to the environment that we've faced, because it's going to be a lot harder to generate the returns in the future that we've been able to generate in the past, just because where markets are currently and where interest rates are. But we think our clients need to adapt in a similar way and be more dynamic as well. They need to shift from being savers to thinking like an investor and really thinking about how they're going to allocate their money to grow it over the long term. Now, what do I mean when I say investors need to be more flexible and dynamic? Well, it could be something as simple as being ready and being prepared so that when there is another downturn in markets, taking a bit of money out of a conservative fund, as an example, and putting it into a growth fund. And we saw a lot of our more experienced clients and our long-standing clients that have relationship with advisors do just that during the downturn, and we're really pleased that that worked out really well for them. Now, at the same stage, you might have got to a point where you're actually well ahead of your retirement goals. You've had a strong period in markets, and that could be an opportunity to take money out of a growth fund and put it back into a conservative fund. So that's one really important parallel, being dynamic. And I think the other important parallel relates back to what Sam said earlier, and we were getting on the phone to our portfolio companies during the downturn to really understand what they were doing to adapt to the crisis, and also getting in touch with us in good times and in bad times to get a sense for how your investment strategy is going and your portfolio is going can really help out. And we found that through time, those clients that get in touch with us regularly and have a relationship through times like the GFC and COVID have really been able to manage their portfolio a lot better, take advantage of opportunities, but also leave their money in there and stick with it through thick and thin. And we think that really helps clients.
Great, thanks Ash. This is a great time to talk to Vicky. Vicky Watson is one of our senior client advisors. She's worked with clients over a number of years, helping them build their wealth. And I think she's got two really great perspectives to add to the conversation today. First and foremost, to talk about the sorts of questions that clients often ask, because I know one thing that makes a lot of us nervous is asking for help. And when we realise that our questions are the same questions that everyone else has, I think that can help us empower us as investors. And secondly, to share some of the advice that she would, or the advice and wisdom that she would share with those clients. Vicky, it's understandable that clients do wonder about the effect of elections and maybe hold off investing because they're uncertain about the outcome. Do you think that's a rational strategy? Should we factor elections into our thinking when we decide to invest our money?
I think there's a lot of noise in the media at the moment, and we all get caught up on that it might have a big impact on our investments, but actually in the long term it doesn't, and even in the short term it might only have a small blip. Our companies operate immaterial of who is in government at the time, and when we research, and I'm sure our fund managers will reinforce this, when we're looking at companies that will operate in all environments, and doesn't matter who's in government at the time. And so you might get some blips on the horizon because there might be some unexpecteds, just like we get shocks, but that will smooth out in volatility. And if you wait, you're never going to pick the right time to invest. You're better to get on with it now, structure your portfolio and move on.
If you were to think about the things that sometimes we don't get right as investors as we're trying to build our wealth, can you maybe share some of the things that I guess are pitfalls that we could all fall in as we build our wealth towards retirement?
Okay, I think a lot of people actually like to have absolutes in their investments. They like to turn around and say, I know what I'm going to get in a return. And I don't like to say just New Zealanders like that, but a lot of New Zealanders have had experience with term deposits, and they know they get a certain return. Well, we know term deposits aren't really going to make it for them from now on, and they need to actually look at actually having a balanced portfolio like I mentioned before. So that's probably one of the biggest areas, because they then actually look, and there'll be advertisements and papers and that sort of thing, and a lot of people fell into that trap just before the great financial crisis of finance companies offering these sorts of returns, etc., etc. And we're even seeing now, mortgage trusts and all sorts of things offering definite returns, but do we know that they are secure? You're investing in one company, and what clients have got to understand is they should be investing in a diverse lot of investments, and make sure they've got these growth assets, as I mentioned before.
Okay. For the younger people watching, my daughter, she's just turned 22. She's about finally to finish university, and maybe those checks will all drop to zero. What sort of advice have you got for the younger people building towards their retirement savings? What should they be doing?
I think it's, a lot of younger people, retirement seems way off, but anyone even under 50, you've got to actually look and say they've got a lot of time on their side and they should be actually looking purely at growth assets. So as advisors, we go along and we say, right, you're going to do your risk profile and see how you think about money and all that sort of good stuff, but really, if you're under 50, you should go straight into the growth assets and just plough your money in there. I would like to say, you've got to understand as well that 3% in KiwiSaver is not really enough. The rest of the world think about saving 10% of their income. That's sort of just the standard. And so people should try and up that. Before they know it, retirement's just round the corner. And so they should be trying to save those sort of things. Other things is, you often see people think, oh, I'll get to the end of my pay period or whatever, and I'll save what's left over. Well, we all know, especially me, there's not going to be any left over, so you've got to set that automatic payment up when the income comes in. Some of my clients even, I say to them, just keep a little notebook for a week or so. You'd be surprised how you fritter away money. And if you do all these good things, it will all help you add to your savings over time.
I will say my 22-year-old does remind me about frittering money away from time to time.
I really am. I can't really talk on that one either.
I did cancel her Afterpay account. So yeah, sorry, David. As I've mentioned, we've lived through tumultuous times. There's still a major health impact from COVID, and that's changing the way that we live, the way that we think, the way that we operate. It's had a major impact on the global economy. Interest rates are as low as they've ever been. Governments are becoming parts of our lives in ways that they've never been before, and the way and the things we demand as consumers are changing quickly and dramatically, and companies have had to pivot to this very, very fast. What we've seen is the best companies have done that very well, and there are definite winners and losers from that. Similarly, in the way that we manage your money, we manage our portfolios, we've had to make these very rapid adjustments and find new opportunities to build and enhance your returns. And last but not least, for all of us as savers, we too need to be dynamic in how we manage our money. The old-fashioned way, the way of putting our money in bank term deposits and letting that build our wealth is just not going to work. And so we need to be more growth-oriented. We genuinely need to be investors, not savers. This has set challenges for all of us, but here at Fisher Funds, it's our job to help navigate those waters, to help meet that challenge, and we're really excited about the opportunities that are being thrown up to us in markets right now.
We had some great questions coming through, some of which we've answered live, but it's really great to have some of the team here. Is it Fisher Fund's view that debt and the increasingly leveraged world that we live in is the #1 issue facing investment markets over the next 5 to 10 years?
Okay, thanks, Kath. It certainly is one of the major issues. Hard to depict which one is the most important, but it certainly is very, very important. And the reason it's important, actually, I spoke about this last year at the Roadshow, where I talked about the 3 deflationary Ds, and the first one was debt. And so certainly the amount of debt that the planet is dealing with and continues to add to by the minute is definitely having a large effect on the way that the economic cycle works, but also not only how the natural cycle works, how the response function from governments and central banks play a role in that cycle. So yes, it is a very important factor and one that we keep a very close eye on here at Fisher Funds. I think certainly where we think where this lower growth and lower inflationary environment then starts to play out is that it'll have an impact on interest rates, the cost of money, and that, in our opinion, will stay low for an extended period of time.
Yeah, okay, thanks, Dave. So a few questions here that's something very close to our hearts is there any growth companies left in the New Zealand market? And I know, Sam, you're going to have some very strong views on this.
Thanks, Kath. I do have some strong views. The answer is yes, no, absolutely. So a few points there. For context, firstly, if we go back pre-COVID to give you an underlying growth rate on the New Zealand portfolio, the underlying growth rate in aggregate for our EPS for those companies was about 12%. So that's about twice the market growth. So absolutely there's some growth left there from an aggregate perspective. But if we just take an example of Mainfreight yesterday, who reported their preliminary results for the first half of their 21 fiscal year, their profit before tax was growing at 22% year on year. So if you consider that in the context of one of the weakest periods of growth we've ever had, or any of us can ever remember, that's quite remarkable. So there's some absolutely some growth companies out there.
Yeah, and just on that, Sam, a question that has come back and we asked a bit is around markets have bounced back despite a very weak global economy. So where to from here for financial markets?
You're not going to catch me out, Kath, on a market call here, but I'm going to give you some points for context here. So you're right, in an absolute sense, markets are at all-time highs, and optically valuations look quite high. But as Dave said, these valuations don't exist in a vacuum, so interest rates are low and possibly going lower given Dave's 3Ds. So the price of money is cheap, so therefore in a relative context, equity valuations look okay. So that's the first point. You still haven't caught me out on a market call there, Kath. The second point is, at Fisher Funds, as you well know, we invest with the theme of moats, but also we look for companies that have really long runways for growth, almost irrespective of that economic backdrop. So last year we gave you the example of Xero. Their total addressable market is very underpenetrated. Cloud accounting penetration is less than 20% globally. Xero's best placed to get the lion's share of that. So, years, if not decades, of growth ahead of them. And then Mainfreight's the other example. I mean, they're taking market share globally. They're very, very small in the European and US markets, and we think they're very well positioned for years, if not decades, of growth.
Yeah, great, thanks. So Frank, we've got time for a couple more questions. So one of the questions that has come up is, I'm wondering how Fisher Funds views investment platforms such as Hatch.
Wow. That's an awesome question. And look, there's, I guess, a preponderance of these platforms popping up. There's the Hatch, there's Sharesies in New Zealand, Robinhood is the big famous one in the US. And COVID has had some strange effects, hasn't it? All sorts of good and bad ones. And one of the strange ones was that we all went home and became share traders, and these big platforms have become incredibly popular. I am a massive fan of what that means for all of us, actually. What is it? Why am I a fan of it? Because many people are actually trying to invest for the very first time in their lives. They're learning the trials and tribulations of what it means to be an owner of a company, to watch share prices day to day, and to try and understand how you improve as an investor. So big fan of it. I do think, though, there's a lot of lessons that we can all learn about it. And one of the things that I've counselled people on is to try and be very thoughtful and mindful about how you do that. So it's not just like buying a lottery ticket. You're actually now an owner of a company. So think long term about that investment. Look for the sorts of things that we think drive shares, great companies, great competitive positions, and keep a note of how things go and learn from the experience. So I think it will make all of us better investors. I think it's a great trend and a pretty exciting one.
Good, cool. That's great. But obviously, if you want real good advice, you should come and talk to one of our team as well, Frank. We've got one more question, which is for you, Frank, again. And I mentioned it at the beginning. So is broccoli and chicken still on the menu?
Well, yeah, so those of you that attended last year's Roadshow will remember my particularly cheesy entree to that Roadshow, where I talked about my chicken and broccoli obsession. The sad reality of the world that we're in is that with interest rates even lower, that chicken and broccoli diet is starting to look like quite a flash one. So if with interest rates where they are, I'm afraid to say it's almost looking more like broccoli this year. And I guess that is actually the central theme of the conversation that we've had today, is that we all do have to make our money work harder so we can avoid just having to eat broccoli all the time. So, invest with a long-term vision, become an investor, not a saver, have a real strategy and build your wealth, and hopefully you'll be able to have a diet a little more exciting than just broccoli.
Great, thanks. Thanks so much. A big thanks to the investment team and Vicky from our advice team. It's been great to host them here today, and we hope you've enjoyed the session. Please remember, get in touch with us if you've got any questions or you want to find out more, and we look forward to seeing you in person really soon. Thank you.